Good day, ladies and gentlemen, and welcome to Foresight Solar full year results presentation. At this time, all participants are in listen-only mode. Later, we will conduct a question and answer session. If you wish to ask a question, we ask that you please use the raise hand function at the bottom of your Zoom screen. If you've dialed in, please select *9 to raise your hand and *6 to unmute. Instructions will follow at the time of Q&A. Participants can also submit questions through the webcast page using the Ask a Question button. I would like to remind all participants that this call is being recorded. Questions will follow the presentation. I will now hand over to Toby Verno, Fund Manager, and David Goodwin, Head of Fund Finance, to start the presentation.
Brilliant. Thank you very much. And good morning, everyone. Good morning in the room and good morning to everyone on the line. We're here today to talk about the annual results for Foresight Solar for 2025. As just introduced, you've got myself, Toby Verno, here in the room, Fund Manager to FSFL, and I'm joined by David Goodwin today, Finance Director within the team. We've got an agenda within the slide deck. We intend to run through the results, operational financial performance, reaffirm what's been previously announced in our Q4 NAV, an overview of corporate actions and the board's focus on delivering shareholder value, some comment on regulatory outlook and tailwinds and headwinds for the sector, and then we'll take some questions at the end of the presentation. Before diving into the meat of the presentation, we do have one very exciting announcement to make, and that's the disclosure that we are set to be joined by a new team member. We have Will Morgan, who will be strengthening the FSFL team starting from as soon as April. Will brings a wealth of experience to the fund. He's got over 20 years of investment experience, and the vast majority of that is in infrastructure and power markets, and a very healthy sort of deal flow under his belt, and strong experience building teams throughout these last couple of decades. We're really excited for him to join the team and to be able to introduce him to the market in due course, and no doubt we'll be doing the rounds to speak with both analysts and shareholders over the coming weeks once he joins mid-April. Moving on now to Foresight Solar's highlights for 2025. Starting with operational performance, it was another strong year for the fund, particularly from our home market of the UK, which saw 3.4% generation outperformance. This offset underperformance in the overseas portfolios, which was driven by curtailment in both Australia and Spain. We're going to go into some detail later as to how we've reflected our consistent outperformance of budget in the UK into our revised budgets going forwards, as supported by work by an independent technical advisor. And we know that there's some detail there, so sort of under the bonnet look, and we're keen to be able to provide some insights there for the reader. Both our production and our revenue strategy have contributed to meeting our dividend cover target of 1.3 times for 2025. That's a really great result, against the macro backdrop and the headwinds that have faced the sector during the period, and a testament to the strategy that we continue to follow. And looking forward into 2026, we're particularly pleased to be able to announce that we are maintaining our dividend, which we consider to be very attractive at 8.1 pence per share. At today's share price, that's around a 13.4% yield, incredibly high yield on a fully cash covered basis looking out for 2026. We do have a somewhat convoluted soundbite here, but please do hear me out. So based on performance year to date, plus expected contracted generation for the remainder of the year, we already expect to be 1 times dividend covered by adding those things together. On top of that, we maintain meaningful merchant exposure, and at this time of heightened power prices in the wake of the conflict in the Middle East, that is clearly risk to the upside. All of our forecasts will be based on curves that were generated off of data pre-conflict in the Middle East, so we do expect that future periods will likely see some upwards pressure from the power curves, clearly tempered by wider macro considerations. We've seen the impact on gilt rates, so I think it'll be interesting going forwards. But funds like Foresight Solar and the portfolio that we operate, we do provide investors with that exposure to the power markets and exposure to the assets that provide much needed energy security here in Europe. to reduce our reliance on fossil fuels and the roller coaster that we've seen over the last few years in terms of pricing. Turning now to balance sheet, the position is robust. We have a gearing level of 41.2%. Now, this is well within our policy limits and well within targets for us as a fund and as a board. And it does afford us quite a lot of flexibility in terms of our capital allocation strategy. And we think that that's in stark contrast to some of the peers who are either in breach of limits or approaching them. We do continue to operate a leading share buyback program relative to size, and it's only because of our prudent balance sheet management that we're able to do so, so beneficially deploy our capital allocation strategy. We recently have put out our Q4 NAV, and that is reaffirmed in the annual accounts with no adjustments there. And we call out in particular our UK valuation. There's been a number of movements through there. We appreciate it's quite a long valuation bridge, which we'll go into some detail on later on. At 0.97 million per megawatt, we see the UK valuation as being very well benchmarked against the peer group, very comfortably against private transaction benchmarks that we have access to as well. All we can say there is that we have our ear very, very close to the ground in pursuit of our ongoing divestment program. And finally, as touched on in the agenda, we want to provide an update on corporate actions. The board remains incredibly focused on delivering the best outcome possible for shareholders. We were very swift during 2025 to agree a revised fee metric to increase alignment between manager and shareholders. And the board continues to explore a range of strategic options, all with shareholders front and centre of their minds in doing so. As manager, we continue to support the board in exploring these, but it's clear when you look at some of the metrics on this page that the market is really crying out for confidence in valuations and looking to capital recycling. And that's exactly what we're focused on in our divestment program and near-term strategy. Looking at a couple of the metrics on the page, you can see our EV/EBITDA ratio has dropped to as low as 6 times, which benchmarking against the sector appears very, very conservative. And similarly, 13.4% dividend cover on a fully cash covered basis, with such a well optimized and well operating portfolio, again, seems to offer good value. Turning now to a deep dive on operational performance, we have here an extract from the accounts. This is the table summarizing global portfolio generation versus budget. And firstly, I think it's important to state the obvious. It's been a better year than 2024. 2024 saw extremely poor solar resource, and we're pleased to see a normalization of resource availability in 2025. I think in the UK, we certainly all enjoyed the benefits of better weather, and that certainly has fed through to production for the portfolio as well. So we reiterate again, the UK outperformed by 3.4% against budgets as of last year. And that was offsetting downside for both Spain and Australia, which were hampered by curtailment. Now, not all of the funds report on the same basis. This is the gory details, unflattered by adjustments. If we were to add back grid curtailment, so that's times when the grid is down due to outages when the grid is being reinforced by the network operators, that would have increased our global production by 2.6%, actually bringing it above budget. So within the elements that we have direct control over, the uptime of our assets and their strong technical performance, we continue to perform very, very well, as a global portfolio. Clearly, there is risk of further grid outages over these coming years. We do maintain realistic assumptions, as we'll come on to in a minute, that have been benchmarked by an advisor. In the lower half of this slide, you can also see the UK's track record. And, we're very pleased to say that in 9 of the last 12 years since IPO, we've outperformed our production budgets. That's obviously a track record we're very proud of. And that is what spurred us on in the course of last year to look to re-benchmark the goalpost that we set ourselves and the hurdle that we set ourselves in our reporting. And we did so by appointing an independent technical advisor who looked at actual operational data for many years to rebase the energy yield expectations for the fund, and to update and reaffirm our key technical valuation inputs going forwards. And just turning over the slide, what we want to do in this presentation today is just to give a bit more colour on these key technical assumptions. We split them out in the NAV bridge, which we'll come to later. These generation input assumptions are absolutely core to the valuation of generation assets, but they do not get the airtime that they probably deserve. And so what we wanted to make sure is that the reader has a full understanding of what has been looked at by the technical advisor and how that impacts the fund going forwards. So taking a look at these in turn, first and foremost is energy yield. And this is how much energy the portfolio is expected to generate based on expected solar resource and the technical efficiency of the projects, i.e. how efficiently the projects convert the incident radiation into electricity that's exported to the grid. And so bearing in mind that for the majority of our portfolio, these budgets were set on acquisition, and in most cases that was either at or shortly following commissioning, so largely based on simulation rather than actual operations. We now have a wealth of operational data that the technical advisor has been able to look at, and in doing so, they're able to give a much more accurate view as to how these sites are expected to perform going forwards. And that resulted in an uplift in energy yield expectation of 2.8% for the UK portfolio, as reported at the Q4 NAV. Clearly, it's important that whilst the sun shines, our assets are up and running in order to make to make the most of that incident radiation and to generate as much electricity as possible. We also asked the TA to look at our availability analysis, and we structured this as a downwards only revision. So we capped the possible availability recommendation at the previous assumed rate of 99%. And we're pleased to say that because of the good uptime that we maintain, both through our spare part strategy and through active operational oversight, multiple layers, both from Foresight asset management teams and management services teams, that the weighted average availability has fallen by just a fraction of a percent in this downwards only revision that was put through. And we think that's testament to the good operations that Julian Ellsworth and the team lead as he has done since IPO for the fund. In terms of life cycle, this is the expected investment that's required over the life of the portfolio in order to maintain good operations for the targeted asset life. Again, the technical advisor has reviewed our forecasts and they've made site-specific adjustments, and this takes into account the failure rates of specific components installed at each site and also local environmental conditions. So we think again that this key input has been, had the tires well kicked at this latest update to the NAV, and we remain very confident in our budgeting going forwards. Now, it's important to highlight that life cycle expenditure for most of the UK fleet is going to be coming to the foreground in the coming years. And that's because key components such as inverters are going to start to reach the end of their useful lives and need replacing. So it's going to be really telling, how well that process is managed by looking at good uptime in periods to come and how effectively, those life cycle costs have been budgeted for. Finally, I come on to economic life, and this has been looked at both on a technical perspective and a commercial perspective. And touching on the technical side of things, it's not so long ago that the expectation in terms of technical life for a solar project wasn't more than 20 or 25 years. About a decade ago, that was the base case expectation. It's been demonstrably clear that solar assets are lasting significantly longer and are not degrading as quickly. And this is what's been reaffirmed by the technical analysis that our advisor has done in this instance. And they have confirmed that our portfolio is no exception to this and should expect to be able to operate for at least 40 years. And we believe that represents a true reflection of the value that's attributed to these assets, where there is a good expectation of securing planning and lease extensions. And we have already been successful in doing so and continue to build on that track record. Hopefully that's provided a bit of a under the bonnet look. More than happy to take questions at the end if there's any technical matters that you want to get into further detail on. But for now, I turn to the next slide, and we're looking at the revenue performance of the fund and our hedging strategy. Now, as you can see, we're stretching out the view to the next 4 years. Typically, we only show the next couple of years. And what is clear is that the income strategy of the fund is underpinned by a solid portion of contracted revenues of around 60%. And that's made up of subsidies, primarily from the UK portfolio, but also Australia, and also long-term PPAs, taking the example of Spain, where we have 10-year fixed price PPAs for 70% of generation. On top of that, we have merchant exposure across each of our markets. Now, we manage our merchant exposure through an active hedging program, and that's evident in the augmentation of years 2026 and 2027, where you can see that thick black bar representing contracted revenues as we define them through financial hedges that we have executed. For 2026, this has been particularly successful case study. We have gradually, if you look back through the last few quarters of reporting, built this position, gradually adding accretive hedges and taking advantage of volatility in the power markets to build a substantial proportion of contracted revenues at a little over 80%. And as mentioned at the outset, those contracted revenues in tandem with the actual generation to date already underwrite a 1x dividend cover based on expected generation for the year. Over and above that, you can see that we retain meaningful exposure to the markets, and that is important at this time because we are expecting risk to the upside in light of the conflict in the Middle East and the heightened power markets that we're observing today. This pattern is set to be replicated for 2027 and 2028 as we are gradually building our hedge positions there. And this disciplined approach to our revenue strategy is really entirely focused at providing revenue visibility to support dividend cover going forwards and continue to deliver our progressive dividend strategy on a sustainable basis. I'm going to take a pause now, and I'm going to hand over to David, who's going to take us through what this has meant for our dividend cover, both past and looking forwards as well.
Thanks, Toby. Dividend cover was a clear highlight for 2025, delivered a 1.3 times cover, which is exactly what we set out to achieve. This result reflects both excellent operational performance and disciplined financial management. Strong asset performance in the UK, the hedging strategy that Toby has described, and the reduction in investment management fees following the change in fee structure all contributed to achieving the 1.3 times cover. We wanted to make the components behind that outcome clearer, which is why we've included the table in the slide. In the annual report, we bridge from accruals-based financial performance to the actual cash distributed from the underlying assets, and that figure is what you see as B in the table. It provides a more intuitive picture of how the business converts accounting profits into available cash for distributions. And to confirm, the dividend cover is calculated by dividing the cash flow from operations by the dividends paid to shareholders in the period, which are marked C and D respectively. And to emphasize Toby's convoluted soundbite, looking ahead, based on what we know today, we expect the 2026 dividend target of 8.1 pence per share to be around 1.1 times covered. That remains a comfortable level and reflects the visibility we have through contracted revenues. At around 1.1 times, dividend cover is also returning to pre-pandemic levels, which is where we would normally expect to be. The higher levels seen in more recent years are not sustainable in the long term. Moving on to gearing and the balance sheet. Balance sheet management is one of the key ways we aim to deliver value to shareholders. During 2025, we resized and extended our revolving credit facility, which is expected to save around £1 million in interest over its life. That is a straightforward benefit to investors. Our long-term gearing continues to amortize steadily in line with project subsidies. Overall, gearing stands at just over 41%, which keeps us well within the 50% investment policy limit and provides flexibility. You may have noticed on the previous slide that the financing costs have reduced. This is largely a factor of the multi-currency RCF, which allows us to draw down on euro-denominated financing and gives a natural hedge against a Spanish portfolio. Looking more broadly, we continue to explore opportunities and optimize the capital structure. If we can release cash through financing steps, disposals, or other levers, we can allocate it where it has the most impact, whether that's returning capital, paying down debt, or reinvesting to enhance long-term revenues.
Cool. Thanks, David. We're now going to move on to the NAV bridge. So this was pre-announced in our Q4 NAV announcement of a few weeks ago, but this presents a full year view. And unfortunately, 25 did see a significant fall in the portfolio NAV falling to 99.2 pence per share at the year end. Now, the key drivers for this are well documented, and these included a moderation of long-term power price forecasts, as these now have moved beyond the initial shock of the invasion of Ukraine on European energy markets, albeit admittedly, we're now amidst an emerging shock, which may well be more structural and of unknown duration. And we do expect that to feed through to power curves in the coming periods. We've also written down the value of the Australian portfolio. We went through a competitive sales process last year and got lots of feedback from the market. And we are aware of the challenges in that market and the reduced investor appetite. And so we marked down the projects there accordingly, which saw a fairly sizable impact to NAV. And then there was also the material negative impact arising from the tax review, which was covered in both the Q3 and Q4 NAV updates. On this final point, we know this has been extremely disappointing for shareholders. And one thing that we are keen to reaffirm is that this issue is now concluded and there are no further impacts expected. In terms of mitigating factors to the NAV, we've already touched on some of the key operational changes. And I'll come on to talk more about the commissioning of our first battery storage project, which saw good value accretion for our shareholders as that moved from construction into commercial operations. And similarly, the buyback continues to improve shareholder value, contributing a further 0.9 pence per share in the period, with a further 11 million deployed towards that 60 million target. Now, we've already gone into some detail on some of the positive movements here in the NAV bridge. David's now going to lead us through some of the key messages regarding the tax review.
Thanks, Toby. We're obviously very disappointed with the overall impacts. It's certainly not the outcome we wanted to deliver. However, we felt it was important to provide more detail so everyone has a better understanding of what has happened and why. Between the Q3 and Q4 announcements, we continued to conduct a thorough review of the group's tax structure alongside our advisors to ensure the analysis was robust and complete. During the whole tax process, we've engaged voluntarily with HMRC. That engagement has now concluded, and we've reached an agreement that covers both the historic tax submissions and the methodology we will apply going forward. This gives us greater clarity and certainty around thin capitalisation, transfer pricing, and ultimately the future tax payments. One of the adjustments made in respect to the forecast was largely to reflect a reduction in interest deductibility, partly because the company's financing structure in the future periods has effectively reached its debt capacity under thin capitalisation rules and the agreements and the principles we have agreed with HMRC. So as interest deductibility falls, the taxable income increases, and consequently, the amount of cash tax we need to pay has increased. The review also confirmed the tax payable for some prior years was higher than previously paid on accounts. These historical liabilities will be settled through existing reserves and normal operational cash flows. Importantly, dividends remain fully covered, including the historical periods, and the Q4 update now draws a line under the matter.
Fantastic. Thank you, David. We're turning now to a more positive note, and that's the commissioning of our first battery storage project at Sandridge. In spite of the delays in this construction process that we've reported over the last couple of years, driven by delays in the grid infrastructure being implemented by the distribution network operator, we're very pleased to see this project come online, now in commercial operations and positively contributing to portfolio cash generation. As we have moved from our previous cost basis for valuation to a DCF valuation, that has increased value for shareholders and accreting 0.4 pence per share. This really exhibits great cost control through what became a protracted construction process, and that's testament to the support we get from the wider Foresight Group in terms of managing these construction projects, which are most important to generating value for our shareholders. The revenue strategy for this project is primarily a merchant traded one, and this naturally complements the market exposures of the generation portfolio. And it's a real great example of the value that can be added through well-executed development construction, but also how investing for new assets is really important for furthering the revenue profile of the portfolio as a whole. Increased Cycling of assets and bringing through further construction projects is something we expect to be doing more of in periods to come. And we do hope to provide, further information on this in the weeks and months ahead. Turning to the next slide, we included this chart in the annual accounts to illustrate, on a simplified basis, the development and construction cycle. And in this case, it's for a generic UK solar asset. And this shows how value is added through the development and construction process and the amount of capital that's at risk at each stage. And what you can see is that in the early stages of development, there's very low levels of capital required in order to further these projects. And there is the opportunity to achieve attractive multiples on that capital. But we should note that this will only ever be relative to the low levels of capital to put at risk. The bigger prize in many ways is to bring projects through construction that can then positively enhance the revenue profile of the portfolio going forwards and achieve even more meaningful valuation uplifts for our shareholders. Delivering on this, it is key to cycle our assets efficiently, and that is what we are focused on through our divestment program, aiming to recycle well and gradually augment our portfolio as we rotate into new assets that will support our dividend objectives and growth targets for years to come. What is also clear is that it is important to be careful in deal structuring. There is risk in development, and whilst the prizes can be high in terms of multiples, there is also risk to the downside, and there is natural attrition as you bring pipelines through. Through careful deal structuring, investors such as Foresight Solar aim to mitigate this risk through things like cross-collateralization and backdated payments to development partners. Overall, we think that this is a really key part of our growth strategy that complements our income strategy and helps to mitigate runoff of NAV over time. And that's really, really key if we're able to deliver our investment objective on a sustainable basis. Again, we hope to be providing further updates in due course on our divestment program. And in doing so, we'll paint a picture as to how we see efficient asset cycling progressing going forwards for Foresight Solar. Moving now to corporate activity. And we want to summarize on this slide, which is an update to previous slides that followed a similar format, some of the key initiatives that are being pursued both by the board, supported by the investment manager. In terms of capital allocation, we have continued to follow a very consistent and clear strategy. We have possibly the largest share buyback program relative to fund size in the market. And we also have a strong focus on paying down our floating rate debt, albeit, as David touched on earlier, the cost of that floating rate debt in our RCF is actually very well managed and not so expensive relative to peers. These two key capital allocation priorities remain in place, and proceeds from future disposals will be balanced between these two options, likely with a increased focus on paying down the RCF, as we did in the wake of the sale of Lorca. We do also flag the opportunity that presents itself with AR7 having been very successful for UK solar portfolios, and auction round 8 being accelerated in the wake of the looming energy crisis. And so we do see this as bringing a very attractive pipeline and probably a wave of opportunities to the market that will present good targets for FSFL in order to enhance its portfolio's revenue profile going forwards. And that's something we've got our ear very close to the ground on as a house, and we benefit from the broader pipeline of Foresight Group. In terms of the board and governance, there continues to be good, positive, proactive action taken by the board in pursuit of shareholder value. We were amongst the first of the funds to secure a new fee deal between the manager and the board, increasing alignment between manager and shareholders as we went to 50% weighting of NAV and market cap on an average basis in the period. The directors do want to acknowledge the discontinuation vote and want to emphasise that they are being proactive in looking at all options available, and that includes both mergers with other public funds, as emerged in the news last year, where an approach was unfortunately rebuffed at an early stage before detailed discussions could take place, but also looking at private options as well. We can only say so much at this time, but there is a very attractive, portfolio that continues to be attractive to long-dated capital, and there is opportunity to potentially release capital from that portfolio as a result. We think that by exploring all of these options, it gives the best possibility to secure good value for shareholders and to continue to deliver our investment objective on a sustainable basis. I'll hand back over to David now, who's going to touch on some of the tailwinds and headwinds facing the sector.
Yeah, thanks, Toby. So finally, a word on the broader environment. We remain very positive about the outlook for Foresight Solar. Energy security and affordability have returned to the top policy agendas, and solar remains one of the cheapest and quickest to deploy sources of power generation. UK policy signals have been mixed. On one hand, the conclusions for REMA were practical. On the other, the ROC and FIT consultation were less helpful. And we are monitoring the upcoming fixed price certificate consultation closely. However, as Toby has touched on, there are strong positives. Allocation round 7 awarded 5 gigawatts of solar capacity at attractive prices. And as Toby mentioned, the AR8 has been accelerated. These auctions create a steady flow of new projects and opportunities to recycle capital for Foresight Solar, enhance the long-term revenue quality. The conflict in the Middle East has also created volatility in natural gas prices. Beyond the broader implications of war, the unpredictability in energy markets adds uncertainty to mid-term price expectations. We responded by hedging production at dividend accretive prices. So on a P50 basis, Q1 production and contracted revenues alone gives us around 1 times dividend cover for 2026. And we still maintain some merchant exposure that could provide some further upside. In Spain, the renewables market continues to mature. Demand is growing for storage integration is advancing. The revenue framework for battery assets is also improving. Our development pipeline positions as well to benefit from these trends and gives us valuable optionality for the future.
Cool, brilliant. And now we get to our closing slide and an opportunity for me to wrap up and just summarize the key points that we've touched upon today. So moving left to right across the slide, it's been another solid year of operational performance, and that has meant that we've been able to deliver on our ambitious dividend cover target of 1.3 times for 2025. Looking ahead, continued strong operational performance as validated through an independent technical analysis and through our active revenue management strategy and hedging strategy, we expect to deliver the same dividend again on a fully cash covered basis. We have very clear priorities and clear capital allocation strategy. We are continuing with our divestment program, and we do hope to provide updates soon. In terms of its allocation, that will be largely focused on payment of our floating rate exposure debt, but also continuing the buyback program that continues to be sector leading in terms of its size. In the mid to long term, we're following a consistent strategy. We're relentlessly delivering on our income proposition to our shareholders, which continues to be extremely attractive. And we've been very pleased to be able to reaffirm to the market that we're committed to the progressive dividend strategy. In order to continue to deliver this on a sustainable basis, we recognise the importance of efficient capital recycling, and that is very central to the near-term strategy for the fund. And in due course, we do hope to provide further updates as this progresses. I'd like to thank you for joining us today and open up the floor now to questions. Starting with those in the room. Matt.
Thanks. Just on the fixed price certificate consultation, I appreciate we haven't even seen the consultation yet, but is the industry and Foresight Group in the room with the government? And even at this early stage, have you got any idea of what the sort of broad outcome might look like?
Absolutely. No, it's clearly a cloud on the horizon for the sector, particularly in the wake of the negative outcome as we saw it to the ROC indexation consultation, albeit it was the lesser of two evils that they landed on at the time. The Russian front's tactic was somewhat transparent. In terms of the FPC consultation, there's clearly a threat here and a fairly unveiled threat that they might go after value in terms of reducing the headroom, as was previously mooted when they did the call for evidence a couple of years ago. Now, we don't have any further visibility on timelines, but Foresight Group is absolutely at the table and working alongside other peers in the sector as well. You know, we're all united in this front. It's bad for the sector, it's bad for renewables, and it's bad for energy security for this country. And we want that message to get across loud and clear to the government that they need to be clear on the ramifications of retrospectively changing support regimes. Energy is amongst one of the most important sectors that they need to foster. And they are trying to accelerate other support regimes in parallel. So investor confidence really hinges on certainty when it comes to that sort of government support. It's not just power that's affected. You know, we're trying to be world leaders in digital. We're trying to be world leaders in other sectors as well. We need to attract people with certainty.
Any idea, any sort of likely timelines?
I think my best bet is latter half of this year, but it's very uncertain. You know, it's been on the back burner for quite a long time. They've got plenty to get on with in terms of energy security and energy markets at the moment. It wouldn't surprise me if this may well end up on the back burner, albeit politically. Unfortunately, you know, it's important to, you know, probably to the government to try and demonstrate an active approach to cost of living, even if the rewards are sometimes limited, as we've seen with ROC indexation consultation.
Thanks.
I'll just take advantage of being in the room to ask 3 quick questions if I can. Just following up on the affordability issue, I guess the other lever the government can potentially pull is the £18 per tonne CPS. You know, the DESNA seems committed to EU ETS linkage, but we're seeing with EU ETS that that's potentially being reformed. But are you hearing anything potentially as to whether the CPS could potentially be reviewed? So that was the first question. Second question, just on asset life assumption. So you've moved to sort of 40 years technical. For the 2 funds where they automatically assume lease extension, or actually for one of the 2, they give a sensitivity. So is there any materiality were you to have lease extension, or can you sort of provide that potential sensitivity? Not necessarily right away. And then the third one was just on the tax review. You know, from a NAV basis, it's all being resolved. Could you perhaps give an indication of the potential materiality on future cash flow, sort of going forward now compared to your sort of prior assumptions?
Cool. No, thank you for that. I'm happy to take each of those in turn. So starting with emissions trading markets. I don't have any further insights to what I think has just been in the press around there are some calls for this to be looked at to promote near-term value for households and consumers. Clearly, it may represent then a step back or a step away from longer-term targets to transition to lower carbon sources of energy. And there are, you know, there's pros and cons. Politically, clear pros in supporting households at a time when no doubt government finances are more stretched than they were, and so the government may be more limited in its ability to offer direct financial support. And so looking at market-based solutions or market intervention, you know, it is a natural thing for them to consider. I do think that it will be slightly short-sighted, as it will probably just, you know, kick the can down the road and mean that when a similar shock comes in the future, because it will, there will be, you know, there have been shocks over the past 50 years, there will continue to be further shocks to the fossil fuels markets. The best defense against that is homegrown clean energy. And so I think they should absolutely bear in mind that and aim to foster a clear long-term strategy when it comes to energy. But it's very understandable the pressure that households be under and the near-term political imperative to do something about that. So no specific insights, I'm afraid, just a speculation in the press. Turning to asset lives and sensitivity against that, I might just touch on the team actually in terms of what we disclose in the annual accounts already, as I think there is some disclosure of sensitivities here. David?
Yes, in note 16 in the accounts, we include a sensitivity on useful economic life, plus or minus 1 year, so it takes into consideration the whole portfolio. Off the top of my head, I'm not entirely.
That's fine. I can check. I haven't got to note 16 in the accounts. Thank you.
It's a long document to get through before 10 a.m. But absolutely, in terms of the commercial rationale for the extension that we've recognised, for almost the entirety of our UK portfolio, we've been successful in extending planning to at least 40 years, if not indefinitely, or just beyond 40 years. Lease extensions, again, we've over time recognise value as we've been successful in bringing those forwards. Now, the thing about lease extensions is that all the parties involved are inherently aligned. There is, at this point, nothing better that many of these landlords can do with this land than host a renewable energy project. And there's a project in situ with a grid connection that's cost millions of pounds to install. There's a lot of friction to changing to doing anything different. So there's really strong alignment there. What you find with the landlords is a lot of it comes down to their own personal financial affairs and tax planning as to when they are most willing to engage with extensions. So we do consider in almost all cases it to be a sort of when rather than an if discussion. Clearly there's risk in terms of the terms available, etc. But broadly speaking, solar farms offer great diversification in terms of revenue for landlords. Typically these are otherwise low quality farmland that solar is built on. So there's a really strong economic argument that these sites will likely continue to be renewable generation assets, not just for the next 40 years, but beyond that, because of all of that grid infrastructure that's gone there before. Clearly, we don't recognise anything beyond 40 years or planning or other site-specific limitations that there may be, as is limited for in our accounts. And then forgive me, the final question
was just tax on future
cash flow. So just to be clear, the impacts that have been recognised through the NAV take into account both the historic increases, and that is the minority of the impact increases, versus amounts that were paid on account to HMRC. Clearly, we had an expectation of becoming tax-paying. We paid tax. We've gone through this process to agree the tax profile with HMRC, and we had underpaid in years to come, in years prior. And so there is a certain degree of true-up. The vast majority of the impact is impacts on future dated forecasts. And so that is absolutely now baked into our assumptions going forwards. And significantly, we don't see it as being a threat to dividend cover in the near term or the long term.
Yeah, I just didn't know whether you could give a sense of pounds million over per annum over the next few years.
We haven't disclosed any sort of quantification of it, but other than the NPV impact.
Yeah, thank you.
Should we go to questions?
Yeah, if there's no more in the room, happy to take some on the line.
We will now start the Q&A on the webinar. If you wish to ask a question, please use the raise hand function at the bottom of your Zoom screen. As a reminder, participants can also submit questions through the webcast page using the Ask a Question button. We'll take our first question from Will Crichton with Cavendish. Please go ahead.
Hi there, thanks for the presentation. First question is, have you also looked at future assumptions around curtailment and DNO outages? I guess to be the main drivers of generation variance to budget. And then secondly, on the inverter replacements program you touched on, could you just give an idea on what the cost of that program might be per annum, and might there be any difficulties in sourcing replacements, noting US Solar has struggled to replace some inverters, albeit in a different market in the US. Thanks.
Cool. No, thank you very much for the questions. I'll take them each in turn. So firstly, on availability, as it may be impacted by curtailment, some slight nuances across markets. In the main market of the UK, curtailment is primarily a function of grid outages as the network is being reinforced, largely to accommodate the transition to greater levels of distributed renewable generation or storage assets. We have seen an increased trend in downtime. We continue to monitor this very carefully and put it through tactically, where we're aware of outages. However, at this time, as we've noted, we've had the technical advisor look at the operational data and reaffirm our availability assumptions going forwards. This was a downwards only revision of the previous assumption, so we do consider these to be quite robust. Clearly, if there are more material outages for larger sites, that will be more impactful in any given year. But where we're forecasting a long-term view and an average spread over a number of years, we do expect this to sort of average out, over time. I know that in 2025 we did see one of our larger sites down for a more prolonged period, and that did impact availability in the UK. If it hadn't been for that, generation would have been even higher than the outperformance that we already saw. So hopefully that touches on the first point. And then just moving on to the question around life cycle investment. and any challenges that might be faced sourcing key components. It is certainly a feature of the sector that in what is once a very fast growing sector with lots of new players, some of those have fallen away over time, and that does mean that there are certain components out there that are no longer supported under warranty or through repair services. We are not immune to that. We do have a small number of sites that are exposed to such such parties. And what we have been doing there, and actually we've got a great case study, that's very live at the moment, where we have been repowering sites. We talked about some of this at the Capital Markets Day a couple of years ago. We've been repowering sites that are, no longer supported with new inverters, and then that has freed up spares that have been used to then further the operations of sites that continue to feature the unsupported inverters. So by taking sort of practical steps such as that, you can manage assets and your spare stock, even where there are manufacturers that may have gone bust. Similarly, there's homegrown UK engineers that are refurbishing some of the kit that is not supported by manufacturers anymore. So by having good relationships in the market, we're able to achieve that good uptime for our assets. Going forward, we've got a very clear strategy and a priority order for addressing any sites that we're seeing underperformance on. And this is it's a very active piece of the fund strategy at the moment, and so expect to hear further updates in due course.
Thanks, Toby.
No problem.
Our next question comes from Charles Murphy of Singer Capital. Please go ahead.
Good morning. Thank you for your presentation. The CFD auctions, what did that tell you about expected returns that the markets, the implied expected returns of those prices using your sort of wider network? I know the fund wasn't participating directly, but I'm sure Foresight had some interests. And then also on the Spanish portfolio, how well did that perform during the Spanish outage?
Thank you, Charlie. Happy to take those questions. So starting with UK CFDs, the outcome price at £65 megawatt hour was actually very close to our central case from our own modelling here at Foresight. And that hopefully gives you an indication as to where we were hoping levels would come out. And from a Foresight Solar perspective, we do consider that it offers an attractive revenue stream for us to target in pursuit of supporting our dividend going forwards. So hopefully you can read into that we think it's come out at quite a good level. You're absolutely right that Foresight, whilst Foresight Solar didn't have any iron in the fire in AR7, other funds managed by Foresight did. We in fact brought through the only nationally significant infrastructure project, and certainly the largest, one of the largest development projects in the UK at West Burton. That's a project that's been developed by another fund. And that hopefully gives you an idea also of the breadth of expertise that Foresight has, and clearly, the sort of buying power that we have in the market where we're bringing through such significant projects. So that's all to the benefit of Foresight Solar, as we can leverage, that weight in the UK solar market. And then, forgive me, what was I saying? Touching on Spain and performance during the outage, which was obviously a key landmark for the country during 2025. I mean, the assets themselves, they saw a temporary outage, as did others. I think where it was relatively short-lived in the scheme of things, what's most significant is the reaction from government to that outage, and what it means for our strategy in Spain going forwards. And we're pleased to say that there's actually really good alignment there. There's been very strong support from government in accelerating initiatives around the deployment of BESS. We have seen capital subsidies for the construction of BESS. Those are targeted at the most developed assets. So those pretty much are ready to build. So we didn't directly benefit from that, but there may well be repeats of that subsidy support going forwards. But significantly for our pipeline, they have also relaxed the development framework for batteries, particularly hybridizing existing generation assets with battery storage. So that could stand to benefit both our operational solar portfolio out there and also our battery pipeline that's coming through as well. It's a very competitive space. Everyone recognises the value that batteries will bring to the Iberian Peninsula, and so grid capacity, is in scarce supply. It's a sort of fastest finger auction process that takes place each month. However, we have been successful in securing already a meaningful progress towards our target in terms of batteries capacity, having already secured 80 megawatts and evaluating further options as we speak. So we look forward to continuing to bring through further updates in due course. Hopefully that's addressed both of your items, Charlie.
Yeah, no, thank you very much. That's it from me.
The next question is from Marcus Jaffe of Peel Hunt. Please go ahead.
Hi, morning. Thanks for the presentation. Are you able to name the technical advisor that reviewed the portfolio valuation assumptions?
We haven't put their name in the public domain. I wouldn't be able to do so without their consent, so I might need to touch base and then follow up with them.
Okay, thanks.
Your next question is from Colette.
Sorry, before we go to Colette, just to add, a well-banked independent technical advisor, with a long track record of looking at projects in the UK market. So yeah, almost certainly one that a reader will be familiar with. Sorry, go ahead, Colette.
All right, your next question comes from Colette Ord of DB. Please go ahead.
Hi, good morning, everyone. Thanks for the presentation. A number of your peers have given a sense of free cash generation in pounds million they expect to have at P50 over the next 5 years. We've sort of had next post-dividend cut of about 40 million, Greencoat close to £1 billion free cash, and Trig have given an expectation of 4% organic CAGR earnings. Can you quantify your position in a similar way so investors can get a sense of what could realistically be available for capital allocation, reinvestment, etc.?
Thanks for that, Colette. This isn't a number that we've got published at this point in time, but I think that we can hopefully give a high-level steer that we do see a normalisation of dividend cover going forwards as we, leave the elevated power price markets in the wake of the invasion of Ukraine by Russia, when we achieved obviously 1.3 times last year, higher levels of dividend cover before that, and we're now looking at 1.1 times for 2026, and that is, I would say, indicative of the, certainly the next couple of years, where sort of, tighter levels of dividend cover are expected, and what we would describe as being more normalised and more akin to pre-COVID levels of dividend cover. So hopefully you can infer from that the sort of free cash flow that will be available. Now, what I would say, probably in contrast to some of the peers, is that the ability to deliver on the investment objective on a sustainable basis will not come down to the reinvestment of dividend cover unless you slash the dividend dramatically, like some people have done recently. We consider that in order to do so sustainably and maintain the dividend targets, what is absolutely key is asset cycling, and so that's efficiently selling and efficiently investing into new projects. A few million of dividend cover either way is not going to allow you to invest meaningfully into new generation assets that are going to enhance portfolio revenues going forwards. What will make a difference is recycling tens of millions of capital and then deploying that into new revenue opportunities that are better placed to take advantage of attractive revenue streams such as the UK CFD. So that is very much, front and centre of our minds as we look to the sustainability of dividend strategy going forwards.
Yeah, points absolutely taken. I guess the pounds million value is quite an important one to sort of be able to do some numbers on. I guess you've got your 75 megawatts up for sale, and if we assume you can achieve your portfolio valuation as it now stands, then we can get some pounds million of reinvestment. But I think it is definitely more helpful for us to have that pounds million version rather than the 1.1, because as you say, that dividend cover number on its own is not sufficient to give the market enough to get a sense for how much we can rely on from the existing portfolio versus that cycling metric, which obviously people need to take a view on what's out there in the market and what you have access to. So it would be a helpful number, I think, in addition to your cover data, to give for us to sort of do some work with.
Cool. No, that's really helpful feedback. Certainly something we can take on board and look to provide some further disclosure around, as we say, as in the coming weeks and months, and acknowledging that the AGM circular will be coming out, in advance of the planned date for the AGM, middle of the summer. I think there'll be an opportunity there for us to hopefully, provide some further disclosure around this strategy going forwards.
Our next question comes
Thank you very
from
much.
Our next question comes from Joe Pepper of RBC Capital Markets. Please go ahead.
Good morning, everybody. Thanks, Scott, for the presentation. Just three from me, all on generation, actually. So the 1.3% budget miss in 25, is that on the latest energy yield assessments, or is this the old one? And then linked to that, could you just give a rough percentage increase in terms of assumed budget of generation that you're assuming going forward, that's baked into that plus 3.9 pence per share increase in the energy yield assessments? And then finally, just coming back briefly to the DNO outages point, if we can, we've kind of seen increased conversations around this with both yourselves and your peer group. Just kind of keen to hear what you think exactly the catalysts are for this to improve, given there's quite a sizable 6.7% operational performance delta in the UK this year. Is it just a case of waiting for increased TOTEX and the RIIO-ED3, or do you expect any sooner catalysts in 26, 27? Thanks.
Cool. Thanks for that, Joe. I actually missed just the last bit of the last question. There's a bit of background noise, but I'll cover the first two items first, and then perhaps we can return to that. So just to clarify, our reporting to date has all been against pre-existing budgets. Now that we have the revised forecasts going forward, we will report solely against the new budgets. So that's the yardstick and the increased hurdle that we are setting ourselves, and will be measured against for periods to come. In terms of the future uplift for the UK portfolio, this is quantified in the Q4 RNS at 2.8% above the current NAV assumption. So hopefully that gives you what you need there. Please do follow up if there's any further insights you need there. And if you wouldn't mind just repeating that the final question, which I think was in relation to the expected trajectory of grid outages in the UK. I'm afraid I just missed the back end of it due to some background noise.
Yeah, of course. Yeah, it's just, as you said, around the DNO outages point, and just to follow up, I suppose, in the previous question, just it'd be great to get a little bit of clarity in terms of what exactly you think the catalysts are. Presumably one of those is RIIO-ED3 and the expected increase in TOTEX spending from 20 onwards. I was just curious to know if you could point to anything sooner, and whether in the kind of catalyst that we could expect to see in 26 or 27. Thanks.
Cool, no problem. So yes, in terms of DNO outages, we do see increased activity as more projects are looking to connect to the grid. Not just generation assets, things in the digital sphere as well. And that will bring some disruption as it comes through. We do have to take a long-term view. It might be that in individual years you see larger assets being affected more or less, and that will hold greater sway over availability within that year. But we think that our long-term valuation assumptions represent a good view, a balanced view of expected uptime for our assets. And that's been borne out. We've actually been, I think, quite accurate in our anticipated financial performance for the portfolio for the last few years. When we go back and we do kind of look at how accurate our predictors have been, in general, we come off quite well there. So we do think that our budgeting is appropriate, and we obviously maintain close ear to the ground and close relations with the DNOs. They're not very good at predicting when there's going to be outages. They try and give a work plan at the start of each year, but inevitably there do seem to be delays. We also do negotiate where we can. It's easier when it's local works compared to sort of more trunk reinforcement activity. But it's not something that you have absolutely no influence over. If it's local works, you can often pay for overtime, push them to do work overnight, push them to do works in the winter. to mitigate the risk of downtime of our sites. The closer you get to the kind of trunk of the electricity network, the harder it is to move such substantial projects around. But nonetheless, our team maintain good relations and aim to minimise downtime where possible. In terms of the catalysts that you describe, I don't think I have any sort of further insights past those points that you mentioned. But yeah, we'll obviously continue to update the market and our expectations for our generation portfolio going forwards.
That's great. Thanks a lot.
Thanks, Joe.
There are no further questions on the webinar. I will now hand over to the management team for any closing remarks.
Fantastic. Well, thank you very much, everyone, for your time today. Please do follow up if there are any further questions, but otherwise we hope that we've been able to give a bit of a flavour for the highlights of the year, and hopefully a nod to what you will expect to hear from us in the coming weeks and months as well, as we continue to deliver on Foresight Solar's strategy. So thanks to everyone in the room, thanks to everyone on the line, and have a very good day.
Thank you for joining today's call. We are no longer live. Have a nice day.